Hello friends and welcome to Unacademy. From today onwards we are starting a new series, that is current economy of the day. So in this series what we will be doing is every day we will take up a current affair related to Indian economy. So we will take up a current affair. We will discuss it in detail from both your prelims perspective and also from your mains perspective. We will be covering all the perspectives of the particular current affair related to Indian economy. So today we will be taking up RBI Monetary Policy Review. So RBI Monetary Policy Review was done by the Monetary Policy Committee very recently, 2 days back. So we will be taking up this topic. We will try to cover everything that is relevant for your examination from this particular topic. Once again, welcome to Unacademy. Now, before we start the session, I would like to introduce to you about the Mentors Workshop, the Unacademy CSE Mentors Workshop, which is going to be held on December 9th at 5:30 p.m. And this time the topic will be collaborative governance. So our guest of honor will be Dr. Kiran Bedi, Honorable Lieutenant Governor of Puducherry. Now, a little bit about the collaborative governance initiative, the Mentors Workshop. So in this collaborative governance mentors workshop, a session will be held in order to help you for the essay writing. So in this session, Dr. Kiran Bedi IPS, retired Honorable Lieutenant Governor of Puducherry, and our top educator Mr. Mrinal Patel will discuss essay writing for mains on the topic. This particular topic, collaborative governance, and this session will be conducted in Hindi, but the notes will be available or provided in English as well. It's on 9th of December, 5:30 p.m. I welcome all of you to participate in this mentors workshop. Now, regarding our app, the learning app of Unacademy, we are providing structured batches provided by our top educators. The classes are given by our top educators and batches will be in Hindi, English, and also bilingual batches are available. So you can join either a 2-year batch or even a late night batch according to your convenience and your flexibility. And in this learning app, we ensure that we will complete 100% of our UPSC CSE syllabus. And we also provide classes on a wide range of optionals. And we also provide prelims and mains test series along with their evaluation. And after that, detailed doubt clearing sessions which shall also be provided, daily answer writing practice, essay writing, etc., performance analysis, sessional quizzes, and interview preparation. Please do download the education app, Unacademy Learning app. Now, a little bit about our Plus subscription, an iconic subscription, Plus UPSC CSE subscription. We are providing it in order to ensure that you will get an offline learning experience. So you can subscribe to our Plus courses, and also iconic UPSC CSE subscriptions are also available, where we will provide a personal coach or a mentor to guide you throughout your preparation. You can also subscribe to our iconic UPSC CSE courses. And for getting subscription, you can use my code, that is Joicy10, JOICY10, in order to avail a 10% of extra discount on the subscriptions. Now, in the Plus platform, that is Unacademy Plus platform, we are also providing free special classes. So to avail the special classes, to unlock the special classes, you can use my code, that is Joicy10. So using this code, you can unlock the free special classes available to you on the Plus platform. And also current affairs daily test series are also available. So with Unacademy, let's crack UPSC CSE. Now, let's come to the topic of discussion for today. So as I said in the beginning, we will be discussing about the monetary policy review held by the RBI recently. So we will see what is the decision taken by the RBI regarding the monetary policy. So MPC, the Monetary Policy Committee of the Reserve Bank of India, has kept the repo rate unchanged at 4%. So this is the most important decision taken by the MPC during the latest monetary policy review. Here I have marked 1, 2 and 3, which indicates that 3 terms are very important for your examination and we need to discuss that in detail. First one is Monetary Policy Committee. So what is a Monetary Policy Committee? It is a committee of members who will take decisions regarding the monetary policy. As we know, monetary policy is the jurisdiction of the central bank. In case of India, the central bank is Reserve Bank of India, or what we call as the RBI. So monetary policy is taken by the MPC in India. MPC is Monetary Policy Committee. Now, how is the composition of MPC? It consists of 6 members, out of which 3 are from RBI and 3 are nominated by the central government. Now, among the 3 members of RBI, one is the chairman of the MPC, the Monetary Policy Committee, that is the governor of RBI. Governor of RBI acts as the chairman of the MPC, and there are 2 other members from the RBI itself. One is the deputy governor in charge of monetary policy, and one more member from RBI. Now, as we said, there are 6 members in MPC, and in case of a tie, then the governor will have a casting vote. So this is how the decisions are made by the MPC. I hope MPC is clear for you. I am not explaining in detail because most of you must be aware about the Monetary Policy Committee. Second term is the repo rate. We need to understand what is a repo rate. Repo rate is the rate at which the RBI lends money to commercial banks. So it is a rate of interest charged by the RBI from the commercial banks by providing loans. Now, RBI has decided to keep it unchanged at 4%. So here we need to know why did the RBI decided to keep the policy rate, that is the repo rate, unchanged. Now, one more thing about the repo rate, it is that repo rate is the benchmark policy rate. So it's the benchmark policy rate. So repo rate is the benchmark policy rate of the RBI. Now, why did RBI keep it unchanged? Keep this question in your mind. We will be answering it towards the end, or by the middle of the lecture you will get a clear answer or clarification for this question. Why did RBI keep it unchanged? Now, second important decision was regarding the reverse repo rate. It was kept unchanged at 3.35%. Here a few things to be noted. One is, what is reverse repo rate? So what is it? From the name itself, it is clear that it's just opposite of repo rate. What is repo rate? It is the interest charged by RBI from the commercial banks on the loans provided by the RBI. So what is reverse repo rate? It is nothing but the interest that the RBI pays to the commercial banks. The rate of interest paid by RBI to the commercial banks on availing loans from the commercial banks. So reverse repo rate was also kept unchanged at 3.35%. Now, another thing here is that how does repo rate and reverse repo rate affect the money supply? Now, first let us discuss about the repo rate. So, repo rate. We know that repo rate is a rate of interest charged by RBI from the commercial banks. Now, if the repo rate is less, what does it mean? It means that the commercial banks can avail more loans from RBI at cheaper rates of interest. So, more loans at cheaper rates of interest. So, what will happen? If the RBI is providing cheaper loans to commercial banks, the commercial banks will take more loans from RBI. And as a result, what the commercial banks will do? They will disperse more credit to the general public or to the public if the repo rate is less. Now, what about reverse repo rate? If the reverse repo rate is less, what does it mean? RBI can avail loans from commercial banks at cheaper rates of interest. Now, it is the discretion of the commercial banks to provide loans either to RBI or to the general public. If the reverse repo rate is less, what does it mean? If the commercial banks are lending to RBI, then the commercial banks will only get lesser rate of interest. So, commercial banks will prefer to give money or loans to the general public. That means the general public can avail more loans from commercial banks, so the money supply will increase. So, in case of repo rate, what happens? When the repo rate is less, it means money supply will increase, and vice versa. In case of reverse repo rate, what happens? When the reverse repo rate is less, money supply will again increase, and vice versa. I hope this concept is clear for you. Now, let us come back to our topic of discussion. So here RBI has kept it unchanged, repo rate and reverse repo rate unchanged. Let's see why RBI has taken that decision. Let's see that later. But I hope repo rate and reverse repo rate, both the concepts are clear for you. This decision was taken unanimously. Unanimously means all the members of the MPC has agreed to it. So all the members of the MPC has agreed to this decision. So there are 6 members. So all the members has agreed to this decision. Now RBI has tried to maintain an accommodative stance. There are basically 3 types of broader classifications for monetary policy. So one is accommodative stance. This accommodative stance is also called liberal stance, or also it is called expansionary monetary policy. Now second one is neutral stance. Third one is contractionary. Or it is also called tightening, calibrated tightening. Calibrated tightening. So these are the 3 broader classifications of monetary policy. Now let us come to monetary policy stance of the RBI. So let's see what are the 3 different types. One is calibrated tightening, another one, as we said, neutral, third is accommodative stance. First is calibrated tightening. So what is calibrated tightening? I said it's also called contractionary monetary policy. Now by the term contractionary, this means RBI is trying to contract the money supply. It is trying to contract the money supply in the economy. So calibrated tightening is contractionary monetary policy, where the RBI is trying to reduce the money supply. And we have seen, in order to reduce the money supply, RBI should increase the repo rate. We have seen that already. So calibrated tightening is a cut in the policy repo rate is off the table, which means RBI is not thinking about reducing the repo rate, which means RBI is trying to increase the repo rate, and MPC is not obliged to increase the rate at every policy meeting. So it is not necessary that the MPC will always increase the policy rate or the repo rate. So basically calibrated tightening means RBI is actually trying to increase the repo rate, thereby reduce the money supply. Second one is neutral stance, where the RBI remains watchful but neutral, and it means that depending upon the situation, RBI can increase or decrease the interest rates. Here it means that RBI is trying to maintain the money supply as it is. Here RBI is trying to maintain the money supply as it is. Depending on the situation, RBI can either increase or decrease. Third is accommodative stance. This is also called expansionary monetary policy. Expansionary monetary policy. Here RBI believes that the economy needs to grow, and hence it will decrease the policy rate. So here expansionary monetary policy means RBI is actually trying to expand the money supply. RBI is trying to expand money supply. Why? Because here RBI believes that if there is an increase in the money supply, only then the economy will grow. More the money supply, more injection of money into the economy can grow better. So this is accommodative stance of the RBI. Now RBI has said that now this time RBI has taken an accommodative stance. Even though the policy rates are kept unchanged, RBI has taken an accommodative stance, which means RBI is now trying to increase the money supply, therefore boost the growth rate in the economy. Next is MPC meeting, the key takeaways of the MPC meeting. So consumer price inflation, that is CPI, was at 7.6% in October. So CPI, or the consumer price inflation, was 7.6% in the month of October. Now here we need to understand that how inflation and how monetary policy is connected. What is inflation basically? Inflation means there is an increase in the money supply. Too much money is chasing too few goods. there is a drastic or a persistent rise in the price of commodities, goods and services in the economy, and this is referred to as inflation. So in an inflation situation, the money supply will be high. So when the money supply is high, the RBI is trying to bring down the money supply to keep the inflation on track. So the CPI inflation, that is retail inflation, was 7.6% in the month of October, and it projects the real GDP growth for financial year 2001 at minus 7.5%. So in the MPC meeting, these are the key takeaways. So regarding inflation, the inflation was calculated at 7.6% for the month of October, and real GDP growth for financial year 2001, it's calculated at minus 7.5%. So there is a negative growth rate. Thirdly, it projects CPI inflation at 6.8% in quarter 3. What is quarter 3? A financial year which starts from April 1st and ends on March 31st. It's divided into 4 quarters of 3 months each. Now, the CPI inflation is projected to be 6.8% for the quarter 3 of financial year 21 and 5.8% in quarter 4 of the financial year 21. So, these are the projections made by the RBI. These are the predictions made by RBI. Inflation rate is likely to remain elevated and expect some relief in CPI data in the winter months. So inflation is supposed to be, or it's likely to be, remained elevated, or it is expected to be at higher rates or to increase, and some relief in the CPI data or CPI based inflation is expected in the winter months. Now regarding monetary policy process, let's see each of them. First is Monetary Policy Committee. It determines the policy interest rate required to achieve the inflation target. So Monetary Policy Committee is responsible for undertaking the monetary policy in the country. Now there are twin objectives of a monetary policy, and it's also often called as monetary policy dilemma. So what are these twin objectives? One is to increase the economic growth, to boost the economic growth. Another one is to keep the inflation on track. Now, why it is called a monetary policy dilemma? The reason why it is called a dilemma is because to increase the rate of economic growth, the money supply needs to be increased. Now, to maintain the inflation at required levels, the money supply needs to be reduced. So, there is a dilemma here. So, what is the purpose of monetary policy? To keep a balance between economic growth and inflation. Just to achieve the economic growth is not enough. Why? Because if the inflation is unchecked and if the inflation is high, whereas the growth rate is high, what will happen? There will be widening of inequalities. 1% of the population, one category of the population will grow in terms of income, whereas the other category or the majority of the population will be suffering due to inflation. So, purpose of Monetary Policy Committee is to maintain a balance between both the economic growth rates and the inflation. So, this is Monetary Policy Committee. Next is Monetary Policy Department of RBI. The Monetary Policy Department of the RBI is responsible for assisting the Monetary Policy Committee in formulating the monetary policy with views of different stakeholders in the economy, and undertakes analytical work of the RBI in order to arrive at a decision regarding the policy repo rate. Policy repo rate is the benchmark policy rate. Repo rate is the benchmark policy rate. Next is the Financial Markets Operations Department. It operationalizes the monetary policy mainly through day-to-day liquidity management operations. So, it is the Financial Markets Operations Department that operationalizes, that is, implements the monetary policy. Implements the monetary policy mainly through day-to-day liquidity management operations. Next is the Financial Market Committee. It meets daily to review the liquidity conditions. So, Financial Market Committee, it meets daily, and the purpose is to review the liquidity conditions. Liquidity means the money supply conditions. Liquidity is related to money supply. So, purpose of Financial Market Committee is to review the liquidity conditions of the market. Next, we will see what are the monetary policy instruments, even though we will not be discussing each of them in much detail here, because all these instruments will be covered in your static portions. So in static economy, we will cover all the monetary policy instruments. So there will not be a detailed discussion on the same now. Let's see what are the monetary policy instruments. So basically, a monetary policy instrument means an instrument used by the RBI in order to regulate the money supply. Now, also we have fiscal policy and fiscal policy instruments. So this refers to the set of instruments used by the central government in order to control the money supply. So we have monetary policy instruments and fiscal policy instruments. So first one is repo rate. Repo rate is the rate of interest charged by the RBI from the commercial banks for loans availed by the commercial banks from the RBI. We have already seen that. Next is reverse repo rate. It is the rate of interest paid by RBI to commercial banks on the loans availed by RBI from commercial banks. Liquidity adjustment facility. It is both the repo rate, reverse repo rate, and along with that the MSF, marginal standing facility, which together makes the liquidity adjustment facility. It means nothing but to adjust the liquidity in the market. Next, we have marginal standing facility. So under marginal standing facility, overnight loans can be given at higher rates of interest by the RBI to the commercial banks. So here the rate of interest will be high. Next is corridor, bank rate, cash reserve ratio, statutory liquidity ratio, open market operations, market stabilization scheme. So all these we will be discussing in much detail in the static portion, not discussing all of them in detail now. CRR, it's nothing but the amount or the percentage of money that the banks have to keep with themselves, percentage of deposits that the bank has to keep with the RBI. It has to be kept with the RBI. Statutory liquidity ratio, the banks have to keep it with themselves. Open market operations, the purchase and the sale of government securities. Market stabilization scheme, then we also have bank rate corridor. So these are the monetary policy instruments of the RBI. So with this we are concluding this session. I hope it is clear for you. I hope the monetary policy review of the RBI is clear for you. Now finally we have to discuss this particular thing, that why the RBI has kept it unchanged. Unchanged at 4%. Repo rate has been kept unchanged at 4%. What is the reason? The reason is nothing but RBI was continuously reducing the repo rates in the recent times because of the slower economic growth. To boost the economic growth, RBI was keeping the repo rates very low. So now RBI has kept it unchanged because if RBI reduces the repo rate, it will go very low. The money supply will increase further, but the rates will be very low, which will not be productive for the economy. If it increases the repo rate, we have already seen that inflation percentage is on the higher side. Inflation will further reduce, but the problem is it will affect the money supply. So this phase we are undergoing a economic slowdown. So in this phase, RBI has to definitely go for an accommodative stance. That is why RBI has kept it unchanged. I hope this is clear for you. Once again, regarding the plus courses, UPSC CSE plus subscription, you can use my code. So iconic UPSC CSE subscription also, you can make use of it. You can use my code, that is Joicy10. You will get a 10% off. Thank you so much for watching. I'll meet you again with another topic.